28th. So, is cash affected? Yeah, we received a check in the mail, and checking account is included in our cash counts for these purposes. Cash has a debit balance. We're going to make it go up by doing the same thing to it, which in this case would be another debit. So we're going to debit cash. Hopefully cash is becoming somewhat routine at this time. We're going to have to credit something. And what are we going to credit? Well, we did do work, so you might say we should be increasing revenue. But we did the work in the past, and when we did the work, we recognized the revenue in the past when we earned it. Therefore, what we're really doing is we're reducing the IOU. So the IOU, being accounts receivable, needs to go down. How do we make something go down? We do the opposite thing to it as what it is, which in this case would be a credit, which we already knew because we debited cash. So we're basically moving it from one asset to another asset. Going to make this large, going to post this out and see if it does what we think it should. So we're going to go to the cash account on the debit side, which is in P22 equals, pointing to H26, and enter. So that makes cash goes up. We're out of bounds. Going to go down to accounts receivable in R40 in the credit column of the T account, the GL account, equals, pointing to the 2000 credit. That'll make us go back in balance here, bring accounts receivable down. So there we have that, and we are back in balance. I'm going to pull this over to the side and do a few more here. We are almost there. We are now on 1122. 1122 says the company donated 5,000 cash to the United Way in the company's name. So is cash affected? Yeah, we donated cash. Cash is going down. How do we make something go down? We do the opposite thing to it. What it is, it's a debit represented by the fact that it does not have brackets. We're going to make it go down by crediting. Crediting goes on the bottom. And we spent 500 on it. What did we spend? What did we get? If I highlight these and say, what account did we donated 5 to the United Way? So I don't see any account really specific on that. And so what we do is we dump that into the good old miscellaneous account. Now, we might have an account. As a bookkeeper, we would probably maybe think about adding an account for donations. If there's a small immaterial amounts that we just want to expense, then we would use miscellaneous expense. Obviously, miscellaneous expense is a very non-descriptive account, so if there's a lot of money in a miscellaneous account, that's not good. But in this case, we have debits here, so we have all debits, and expenses are all debit accounts. They only go up generally in the debit direction. We're going to make it go up, and of course, there will be exceptions to that rule in the future. But for the most part, they only go up. How do we make something go up? We do the same thing to it, which in this case will be another debit, which we already knew because we credited cash. We're going to make this large and then post this out. So we're going to look for miscellaneous expenses in AH24 equals, then point to H29 and enter. That makes miscellaneous expense goes up, brings net income down, puts us out of balance. Then we're going to record the cash in R23 equals, point to the credit in the cash in I30 and enter. Going to pull this to the left-hand side and move on to 1124. The company completed work for Alex's engineering company and sent the bill. Okay, is cash affected? In this case, no, because we just billed it. We didn't actually get the cash yet. Therefore, we did get something. We got an IOU for the work we did, and the IOU is the receivable account. It has a debit balance. People owe us more money, therefore it should go up. How do we make something go up? We do the same thing to it, which in this case would be another debit. So I'm going to debit that, paste in it 1, 2, 3 for the 4.2 that we billed on our invoice, which is going to be a bill to them, invoice to us. We're going to have to credit something 4.2 as well. What are we going to credit? We did work and therefore earned revenue, which we're going to recognize now, even though we haven't received the cash, because under the revenue recognition principle, which is an accrual principle, we recognize revenue when we earned it, not when we receive the cash. And we see that the revenue account has a credit balance. Revenue only goes up. How do we make something go up? We do the same thing to it, which in this case would be another credit. And we already knew that because we debited accounts receivable. Going to make this large. Going to post this out. So we're going to go to accounts receivable in cell P41 equals, point to the receivable. That will increase the receivable here when we hit enter, like so. Then we're going to go to the revenue account, which only has credits in it, because it only goes one way, which is up, equals, and we're going to point to the revenue account, which will make the revenue go up, put us back in balance, bring net income bring net income up, like so. Alright, now we're going to go to 1125. which says the company sent another bill to IMF company for the past due amount of $3,000. So they're not paying us and we're nagging them on it. We already recorded it though, so no entry. So we're just following up on a bill that we did in the past. We already recorded the bill. We're just sending the invoice that we already sent out in the past. So it's a bit of a tricky one there. 1128. The company reimbursed S-Ray in cash for business automobile mileage. Same thing. So we did mileage, our mileage on it. The company's reimbursing us. Is cash affected? Yes, the cash is going down from the company's account. Cash is a credit balance. How do we make it go down? We do the opposite thing to it, which in this case, cash is a debit balance. We need to make it go down. How would we do that? We do the opposite, which in this case would be a credit. Credit's going to go on the bottom, credit in cash, and I'm going to put a negative to calculate it because I want to flip the sign. And we're saying that now we drove 1,200 miles times, which is the asterisk, 0.32 cents per mile. So that gives us 384. And we're going to debit something 384. And it's for the car, the auto again, which we're going to put into mileage expense. All expenses have debit balances. We consumed this expense in order to help us generate revenue in the same time period, which is the definition of an expense. It's the revenue. It's a matching principle, an accrual principle. So therefore, we're going to increase the expense. Expenses only go one way. They go up. They have a debit balance. Therefore, to make them go up, to do the same thing to it would be another debit. So we're going to make this large. We're going to look for the mileage expense on AH 17 equals, pointing to the mileage journal entry in H37 and enter. Then we're going to go to the cash account on R24 equals, point to the credit in cash on I38, and that will put us back in balance here. And there we have that. Moving on to 1130. The company paid $2,000 cash for Lynn Addy's wages. All right, is cash affected? Yep, we paid. Cash has a debit balance. How do I make it go down? We do the opposite thing to it, which in this case would be a credit. Credits go on the bottom. I'm going to put that on the bottom for that reason. For 2,000, if we credit something, we're going to have to debit something for 2,000 as well. And in this case, we are debiting for wages. So what account represents wages here? And we could see wage expense, which makes sense because we consumed someone's labor in order to help us generate revenue in the same time period. Expenses all have debit balances. They only go one way. They go up in the debit direction. How do we make something go up? Do the same thing to it, which in this case would be another debit. Already knew that because we had to credit cash. Therefore, we had to debit something. Let's post it out. So we're going to go up here to wages in cell AB 36 equals the wages over here in H40 and enter. That brought net income down and it puts us out of balance. Then we can post the cash over here in the credit side equals and pointing to the credit in I41 and enter. So cash goes down, puts us back in balance here. We have one more to go, which I'm going to say on 1130. Ray withdrew 3,000 cash from the company. Is cash affected? Yeah, it was withdrawn. How do we make it go down? We do the opposite thing to it. Cash is debit. The opposite would be a credit. Credits go on bottom. We're going to credit cash for the 3,000. If we credit something, we're going to have to debit something. Every transaction has to have at least two accounts and an equal number of debits and credits. Who took it out? Ray. Who's Ray? Ray's the owner. Therefore, you would think it would be the owner's equity section. And we have the withdrawals right here. And this is, again, a little bit confusing to think about because the owner's equity section is really all of this. All of this is owner's equity represented by the accounting equation. And it really has a credit balance, meaning if I highlight these, the credits win. So we're really reducing that by increasing the withdrawals. So withdrawals has a debit balance. It's going to go up, which brings down the amount owed to the owner. It will close out later on to capital, as we shall see at a later time. So I'm going to post that out. And then we're going to look for withdrawals over here. And I'm going to put my cursor on debit, say equals, point to the draws here, and enter. And then we're going to go to the cash and say equals, and point to the cash down here, and that should put us back in balance. Now, if this is in balance, note that this should be in balance, and note that this is the balance sheet. Assets, liabilities, and owner's equity is the balance sheet. So let's take a look at how the balance sheet, how the financials are created. So I'm going to hide this just so I can look at this. And here's our financials, which are being generated. And you can say, okay, there's the assets. Assets equal liabilities plus owner's equity. That's the accounting equation. If we want to see where the assets are coming from, well, they're coming from right there. So if we find a home for everything on the trial balance, it has to work. There's all the assets. There are no liabilities in this case, but I still put it here. And the capital account, like, where's that coming from? It's coming from over here. So we haven't found all this stuff, but I know if I highlight all of that, that adds up to the capital, because the assets, the top half, have to equal the bottom half. So if the assets add up to 92,796, and there's no liabilities, then this must be a credit of 92,796. Now we can see, what about the income statement? The income statement is being driven from, we've got revenue here, and that's coming from, I have to take these off, that's coming from here. And then the expenses, of course, which are here, here, here. And then if we add up the revenue minus the expenses, we come up with net income. Net income here. And then the owner's equity section, that's where we're pulling this number. And the draws are going to be in the owner's equity section. So this is, you can kind of see how this is going to be built. The trial balance is going to build the financial statements. As long as the debits equal the credits, the financial statements will always remain in balance. The balance sheet is basically everything. These two accounts are giving us more detail on this number for the most part, meaning this number is being broken down to its components, meaning part of the owner's equity is being broken out, meaning the draws, and the income, the activity that happened in this time period.